All right, welcome back. We're looking at chapter 3, which has to do with working with financial statement. In the last chapter, we looked at all these financial statements, which included the statement of comprehensive income and also statement of financial position. So those two will be very, very relevant to the chapter we'll be looking at in chapter 3. So what are the key concepts and skills that we'll learn here? The first would be we'll know the sources and uses of firms' cash flows. So that's the first one. We also understand how to standardize financial statement for comparison purposes. And why do we have it? Why is standardizing financial statement, why is it of importance to readers of financial statement? Equally, we also know how to compute and interpret common financial ratios, and also be able to understand the determinant of firms' profitability. We also understand the problem of, and also pitfalls of the financial statement analysis. So basically, that's what this concept and skill will be. So in a nutshell, or chapter outline, we look at cash flows, other financial statements, taking a closer look of the pertinent details that's reported in the statement of statement of cash flows. We also look at the standardized financial statements, and we'll look at the cash flow, the ratio analysis, and using that also look at the due point identity, and using the financial statement information. How do we use it? And basically, that's the total coverage of this chapter. So moving forward, let's look at the sample financial statement of financial position, what it looks like from what we learned in the last chapter. So we have these comparative figures for this company, looking at 2015 and 2014, respectively. And why do we have that? So that we can see, the movement from one period to another, and then find the changes in the period. So that's the whole idea. And basically, in preparing system of cash flow, this is exactly what we need, because with the cash flow, we're looking at the movement from one year to the other. So also we look at the statement of comprehensive income, as we said earlier. Equally, it looks at the revenue of the company minus the expenses, which includes the cost of goods sold, also the expenses, and also the depreciation. And then we'll subtract all those from the revenue. It gives us the earnings before interest and tax, which we call the EBIT. And then from that, we subtract the interest expense. And in this case, 52,841, and that gave us the total taxable income, which is 768,342. And then applying the corporation tax rate, that gives us the tax of 205,426. And we subtract that from the taxable income, we get our net income of 471,916. And based on this, we simply have, now if we're told, for example, in this case, this scenario, we're told that dividend paid is 395,521. So it's not asking us how much or what is the additions to the retained earnings. And this is simple. We simply subtract the amount of dividend paid from the 471,916, and that would be the additions to retained earnings. And that's a simple arithmetic. And so in this case, the retained earnings here will be 76,395. That is the amount that will be added to the retained earnings from last year. So moving forward, what are some of the sources and uses of cash? So when I talk about statement of cash flow, it's simply looking at all the cash activities in the period, using both the statement of comprehensive income and the statement of financial position. So we look at the sources. So in this scenario, we can talk about sources. Sources means where or how or what form cash gets into the company. So here, we call it cash flow. And again, obviously, we say cash flow comes in when we sell something. When we sell something, of course, cash will be received. That's not the only one. It can equally mean that we decrease our asset account. So when we dispose of our asset, and the reason why I use the word dispose is because companies do not typically generate cash from disposing of their assets. And that's why I use the word dispose as opposed to sell. So the decrease the asset account, that also generates cash. The third form of getting cash would be by increasing liability, or when they issue new equity, okay, when they sell when they issue more equity to new shareholders, obviously they get cash in return for that. So those are the sources of cash for an organization. Let's look at the uses or the usage of cash. The first one would be what we call, of course, when we say use of cash, it simply means cash outflow, which means cash leaving the company. So this occurs when we buy something. When we buy something, of course, we have to pay for it. Cash payment means an outflow of cash. It's a use of cash. If not, when we increase our asset, for example, so opposite of what we did earlier with the sources, so here we increase it by acquiring new assets. Of course, we have to pay for it. That's an outflow of cash. The third form of use of cash would be by decreasing our liability or having something called share or common stock repurchase. When you do a common stock repurchase, of course, we take those certificates back or pay the liability back to the creditor, and that reduces our cash. That equally signifies a cash outflow. So our statement of cash flow, therefore, we look at, summarizes both the sources and uses of cash. And as such, this statement will look at three main areas of companies' activities. The first one, which are the main category. The first one will be looking at operating activity. And this operating activity includes the net income and also the changes in most of the current accounts. So with the operating activity, you're looking at two main areas. So look at the net income, which we get from statement of comprehensive income, and all the currents. Currents meaning, which is typically the net changes in net working capital. So looking at the change between the current assets and the current liability. Okay, so that's the areas which operating activity covers. On the other hand, we also look at the investment activity, or sometimes we say investing activity. Investing activity includes changes in fixed assets. These are activities which involve acquiring or disposal of cash. Particularly here, with this, it will relate to activities that company does to increase or generate revenue. So when we acquire assets, the whole idea is, for doing that is to be able to have enough capacity to be able to generate this revenue. And equally, when we dispose it off, definitely cash gets in. So there'll be cash inflow. The third aspect of the statement is the financing activity. And financing activity has to do with everything that has to do with dealing with our financials, also, i.e., people who give us funds to run the company. So it includes changes in notes payable, long-term debt, and equity account, as well as paying dividends to the shareholders. Everything that has to do with financing the company's activity is called the financing activity. So here is what the statement looks like. So the statement looks like, we'll start with the beginning cash of the year. So we'll look at, in the statement which I showed earlier, we showed 2014, 2015. So we'll look at the cash under the current assets in 2014. That's the cash right there, which will be the beginning balance. And so we now start on a line-by-line basis looking at the operating activity. The net income was the net income of $471,916, which we got from the income statement. And then we add back depreciation. Reason why we're adding back depreciation is because depreciation is a non-cash item. It does not involve actual physical payment of cash. So we add it back to our net income. So in this case, we're treating depreciation as cash inflow. And then we subtract. So now, in doing this, we also look at other ways that cash is generated. One of it is an increase in current liability. So we look at current liability last year and compare it with this year. So where if there's an increase, how do you find that? Look at the balance last year, compare with this year. So we'll say the beginning, the closing minus the beginning. So everything be closing minus the beginning. That gives us an increase or a decrease. So in this case, since we took 2015 as the closing and then 2014 as the beginning, so we'll subtract. In this case, we have an increase in other current liability of $141.49. And so, because that increases, it means cash increases. And so we compare the current assets. On the current asset, there's an increase in account receivable. So how do you find that? We look at the balance 2015 minus 2014 in account receivable, and that's an increase in account receivable. Now, we need to understand something. An increase in account receivable means cash is going down. How do we record it? So we record the effect, the impact of that is what we're showing. So in this case, because account receivable increased by $46,000, it decreased cash that comes into the company. And that's why, even though it's an increase, we report it as a decrease. So it means an increase in account receivable means a decrease to cash. That's the implication. We also look at the increase in inventory. Inventory also went up. If you find a difference between, so closing minus opening, we have 93,692, so which means there's an increase. So asset goes up, cash goes down. So that's why 93,000 was reported as a negative figure. Other area we have is the other current asset is an increase, so that went up as well. So increase in asset other current assets means cash went down as well. So we have 82,150 as net cash outflow. Finally, we have the decrease in accounts payable. A decrease in accounts payable means more cash is paid to reduce our obligation. So cash paid out reduces accounts payable, which means more cash is more cash outflow. And so having done all those, so it means we finish all the currents. So all the operating activity is done. We add everything together, and overall residual value, we have the net cash from operating activity. So which in this case, we add everything together. So 471 from net income, plus the depreciation 362,325, and then with the increase in account in current liability of 141.49, and then we subtract the increases in account receivable, increase in inventory, increase in other current liability, current asset, and decrease in accounts payable. So adding all those gave us the net cash from operations, which is 726,387. So the next item is to look at the investment activity. Again, the investment activity here is looking at two things. Now, when we're reporting the fixed assets here, we need to look at the total change. So i.e. total costs. We'll look at the cost of the asset, and that's what we need to find out to actually get to the fixed asset acquisition. But unfortunately, we do not have that figure. So what we did was we took the net fixed assets reported in those two periods and add back depreciation, and that gave us the value of $957.07. So if you find the difference in the two nets, so 2015 net fixed asset minus 2014 net fixed asset plus depreciation in the period will give us that figure of $957,007. So in essence, we have net cash from investing activity is a net outflow here. And so that's the second element of the stream of cash flow. The third element will be the financing activity, equally looking at other areas, long-term debt and rest. So here we look at the increase in note payable. Note payable, looking at 2015 as the closing balance, 2014 as the beginning balance. The difference is an increase, so it means there's an increase in cash flow, 141,217. And also we have an increase in long-term debt. So comparing 2015 to 2014, and that gave us 517,764. There was a decrease in common stock. So stock were repurchased by showing a reduction in the common stocks. So difference is 36,158. And so that means that was a net cash use. And then dividend paid is definitely cash paid out. It's a cash outflow of 395,521. So when we add all the five elements together, we get net cash flow from financing activity of 227,302. And so when we add everything together, we have a change from the changing in net decrease in cash of negative 3,318. We subtract that from the beginning cash balance of 6,489, and that gives us the ending cash balance of 3,170. So which means that is the cash flow statement. Now, this is typically how statements are made. And then what are the benefits of standardizing the financial statement? Well, for example, if we standardize, so for example, common size statement of financial statement, compute all accounts as a percentage. Okay, the reason behind this is so that it gives commonality and also ease of interpretation from one jurisdiction to the other. And as such, we also look at the statement of comprehensive income as well. Equally, it's computed on a line-by-line basis, also as a percentage of sales. Now, the idea behind this, it enhances comparability among jurisdictions and enhances, easy interpretation. So, with the standardized statement, it makes it easier to compare financial statements and also information, particularly, as the company grows. It also enhances ability to assess companies' performance. They're also useful for comparing companies of different sizes, particularly within the same industry. And so that's why we have a standardized financial statement particularly when we follow the International Financial Reporting Standard formula or formats. So basically that's the financial statement. Other areas which we need to also look at in understanding better the financial statement is to look at the ratio analysis. The ratio analysis. Ratio analysis also allows to better understand, also allows to compare through time or between companies, in terms of performance. And then we're able to assess which company is doing well, why they're doing well, and what are they not doing well, and what's responsible. That way, we can actually do the financial assessment. So ratio analysis helps us to be able to ask ourselves, what exactly are we trying to measure, and also why is it important to us? That's what ratio analysis talks about. It's also used for both internally and also externally. And so we're looking at the 5 main areas of the ratio. The first one is looking at the short-term solvency or liquidity ratio. Short-term solvency and liquidity ratio. The second is looking at the long-term solvency or financial leverage ratio. Whereas the third is looking at the asset management or turnover ratio. The fourth is looking at the profitability ratios, and the fifth is looking at the market value ratios. We will take each of them in turn. The first is looking at the liquidity ratio. Again, with liquidity ratio, what does it typically, what information does it tell us? It typically displays companies' ability to continue in operational existence for a foreseeable future. Hence, we're looking at its going concern position. And so one critical way of valuing companies' liquidity ratio is a quick ratio. And it's not far-fetched. What we do with this is looking at all the currents. So we look at current assets divided by current liability. And typically, how we measure it, for every liability which is taken as 1, how many times are we able to pay it? So for every liability, how many times are we able to pay it? So which means, in this case, for example, the current asset we had was 1,801,690, and then we had current liabilities of 1,780,785. By dividing, it means we're able to pay the liability 1.01 times. That's the number of times we're able to pay it. Is that good or bad? Well, we need to also look at other areas, other ratios in that category, and before we're able to determine if it's really good or bad. For every liability, we should be able to pay at least once. So sometimes companies do hide in their inventory, and as such, we're not just to pad up their financial position and then make it look so we can do window dressing. So, and that's the essence of behind coming up with something called quick ratio. So with the quick ratio, what it does is current asset, we subtract the inventory company own, and then we divide it again by the current liability. We see if we're able to at least pay one liability. In this case, the result came as 0.793 times, which means it's even less than 1. So with this result, it's a kind of a pointer telling us that company is likely to be experiencing some liquidity or going concern problems by not having enough cash to pay their obligation as and when fall due. To be able to ascertain if this is really true, we do something called cash ratio. So which means looking at cash and all the cash equivalents, okay, and then divide by the current liability. In this case, company is able to pay their liability 0.002 times, which is far less than the threshold. Again, this is just a simple arithmetic. Again, another thing we need to also consider is looking at the industry average before we're able to finally determine if company is really doing well. But from the mere fact that we did all the calculations, with current ratio showing 1.1, obviously they're only able to pay once. And then with the quick ratio coming, it means they're not even able to pay their liability at least one. So again, it's an indicator that company potentially might be experiencing a kind of a going concern problem based on this calculation. The next one is looking at, again, this is a short-term measure. Now, let's look at long-term measure, which has to do with the long-term solvency ratio. With the long-term solvency ratio, we look at something like the total debt ratio, and so with the total debt ratio, we look at the total asset minus the total equity divided by the total asset. So in this case, we look at number of times. So in this case, we have 0.6429 times, which is 64.29. So which means the firm financed a little over 64% of its asset with debt. So which means the company is tending to be highly geared. Well, anything above 50 shows is high. So now the difference between 100%, so simply mean 64% of the financing of the company is through debt, and 36% is by equity. So which means the debt to equity ratio is 64.36%. That's the ratio in terms of capital structure. Other one we talk about is debt to equity. So debt to equity, in this case, is 1.8 times of the, so which means we have more of debt than the equity. And other ones is looking at the equity multiplier. And the equity multiplier is the measure of company's financial leverage, okay, which is the total asset divided by total equity. So in essence, a higher equity multiplier indicates companies use more of debt, as we've seen earlier. 64% is the amount of financing, in the company. Other areas is the interest cover. So we look at the times interest is earned. So here we look at the earnings before interest and tax divided by the interest that is paid in the period. The more, the better. So in this case, it's lower. So we have the 820,103 as a total earnings before interest and tax, and the actual interest paid was 52,841, which gives us 15.5 times. So which means with the amount of debt that they have, they're able to pay the interest 15.5 times. We also look at the cash coverage. With the cash coverage, we're looking at the earnings before interest and tax plus depreciation divided by the interest. In this case, it's about 22.38 times, a little bit higher, because we added back the depreciation. So that's that has to do with the leverage, which is long term. Other areas which we also compute is called the inventory ratio. This kind of efficiency ratio or use of assets. So the first one is looking at the inventory turnover. With the inventory turnover, we're looking at the cost of goods sold divided by the inventory. Now, word of caution here. If we have two inventory balances, i.e. we have the opening balance and the closing balance, what's suggested that we add the two together and do an average. If not, if one is given, which is typically the ending balance, then we use the ending balance. Other than that, that's how to calculate this inventory. So it's total cost of goods sold divided by average inventory. And if only one is given, then we use it as it is. So in this case, we have 4.53 times. 4.53 times. So with the 4.53 times, it's telling us the number of times that inventory is turned over a period of 1 year. In this case, is 4.53, which can be typically lower. Again, we'll find out with the use of another measure of this particular ratio. So we look at the days in inventory. So days in inventory is simply looking at number of days those inventory stays in our warehouse before they're sold. Here we are. We look and the calculation of that is looking at the number of days in a year, 365, divided by the inventory turnover, which we just calculated. In this case, we have 81 days, so which means we have 81 days the asset sits in the warehouse before being sold. Now, if it stays longer, so we have more than 2 months a product stays in our warehouse before it's sold. What are the problems? Well, the problem we have here with this kind shows that we have a slow-moving item. What's the implication of that? If we have a slow-moving item, it gives rise to obsolescence, so which means it can become obsolete, old, or it can be preferred or stolen, or so which means we have to write them down, means more loss on that. So heating bill, lighting bill, insurance, so all these costs of holding those stocks in the warehouse, which does not add any value, and which means the company will be losing money by holding the inventory in the warehouse. So that's on the inventory side ratio. The next one we'll look at is called the receivable ratios. Receivable ratios has to do with our account receivables. So we look at the number of times they are buying and selling from us. So we look at that. So we look at the sales divided by the account receivable. Again, just like the inventory. If you have two balances, i.e. we have the opening balance and the closing balance of account receivable, we simply add it together and get the average. And so whatever we get, so we use that to divide our sales. Again, with this, we're looking at the higher, the better. But in this case, it's lower. So we're looking at 3.96 times that our inventory and the account receivable are buying and selling, paying, buying and paying, buying and paying. So it's pretty low. And we can see, again, we will confirm this by looking at the days our account receivable is taking to pay off their debt. And so here we are. So here we are. We have 365 days in a year divided by the receivable turnover. So in this case, the number of days that our receivable is taking, holding our money before they pay is 92 days. That's 3 months. That's 1 quarter of the year, which means our money is staying too long with our account receivable before being paid back to us. Again, this kind of situation will mean that we do not have enough cash, liquid cash, to run our operation. Equally, it gives rise to the risk of bad debt, irrecoverable debt, because it's taking too long for our customers to pay off their debt. So it's not a good scenario here. The other one we also look at is total asset turnover. So looking at efficiency of how we use our assets. Okay, so we look at the net working capital turnover, which is the total sales divided by net working capital. So in this case, it's 207.930 times, which is good. We also look at the total asset turnover. Total asset turnover here is very, very low. So we look at sales divided by the net fixed asset. So which means if we only turn over 1.385 times. So the implication of this is that we have too much asset than we need to generate this sales. So which means we are being inefficient with the use of our assets. So not very, very efficient in the use of our assets. So we also look at the total asset turnover. So here we look at 88 time, 0.88 times. So measure of use of efficiency. It's unusual the total asset turnover is lesser than the one, especially if a firm has a large amount of fixed assets. So which, explain the reason why we have 0.88 times. Okay, so that's on the efficiency side. We also look at the fourth, which is the profitability measure. The profitability measure is looking at profit margin, for example. With profit margin, we have the net income divided by sales. So here, profit margin is 10.88%. So which means, over the period, we only return 10.88% of the revenue we generated. Other one is the return on asset. So which is looking at the net income divided by total assets. Again, it's pretty small, which you have 1.57. Okay, so use of asset. Again, this also corroborates with the total asset turnover, which is lower, which we calculated earlier. Let's look at return on equity, so which is net income divided by total equity. Again, we have 26.8%, which is the return that we return on equity. And finally, we look at the market value measures, which look at the price, and the earnings capacity of the company. The price of the market will be given, so market price share will be given, and then we can calculate other ones. Equally, share outstanding will be given based on the number of shares that we have in issue, and based on that we can now calculate other ones. So market value. Now, the market value that we show of the debt here is simply because of the rate that's obtainable on the open market. So the one we represent in the statement of fair financial position was the book value, whereas the market value is gone up. So this is the position of the debt. So with the information provided, we can now calculate something called the earnings per share. EPS means earnings per share. And earnings per share is simply net income divided by the number of shares outstanding. In this case, number of shares outstanding is the number, which is the 205,838,910. And we have net income of 401,916,000. So in essence, the earnings per share for this company is $2.29. $2.29. We can also talk about the price earning ratio. With the price earning ratio is simply the market price divided by earnings per share, which we just calculated. In this case, it's 26.6 times. And other areas that we also calculated is the PEG ratio, which is the ratio, which is the value of a metric for determining the relative trade-off between the price of a stock, the earnings generated, and also company's expected growth. In this case, we have PE ratio divided by the expected returns, earnings growth rate by 100, and that gives us the PEG ratio. Other ones under the market value will be the market to book ratio, which is the market value per share divided by the book value per share. So in this case, we have $60.88, which is the market value price, divided by the average of the book values. So which is the 1,761,044,000. And in this case, the market to book ratio is 7.1 times. And then finally, we have the earnings, the enterprise value, which is the enterprise, which we divide by the earnings before interest and tax, depreciation and amortization. So here we have the market value of equity plus the market value of debt plus the preferred shares plus the minority interest and minus the cash and the cash equivalent divided by the earnings before interest and tax, depreciation and amortization. So in this case, the enterprise value is 11.85%. So in a nutshell, this is the common ratios which we talked about. So we have the short-term solvency, looking at the current ratio, quick ratio, cash ratio, and also we look at the net working capital, which is net working capital divided by the total assets. And also we have the internal measure, which is the interval measures, which is the current asset divided by average daily operating costs. We have the long-term solvency, which look at the total debt ratio, debt to equity ratio, which is the capital structure, equity multiplier, the long-term debt ratio, times interest earned, and also cash coverage ratio. The other ones that the third one we talked about is the asset utilization turnover, which is typically the use of assets, company assets to generate revenue. So looking at the turnovers, inventory, for the days, receivable turnover, days is taken out receivables to pay off, and also looking at net working capital turnover. And then we have the profitability ratio, which is the profit margin, the return on assets, return on equity, and return on equity multiplier as well. And then finally, we have the market value ratio, which has to do with the price to earning ratio, the PEG ratio, the market to book value, and the enterprise value, which we calculated. The last one will be the deriving the dew point identity, which is the return on multiple steps here. We have first we calculate the return on equity, which is the net income divided by total equity, and so we multiply by 1. So that we rearrange it, and then we have the return on equity, which equals the net income divided by total equity multiplied by total asset divided by total asset, which equals net income divided by total asset multiplied by total asset divided by total equity. All will give us the return on asset multiplied by the equity multiplier. And so by multiply by 1, again, we arrange it, and then that's what we get. So in essence, our total, the return on equity, therefore, will be the profit margin multiplied by total asset turnover multiplied by the equity multiplier, which is the dew point identity. So how do we use it? Well, it gives us the profit margin, which is the measure of firm's operating efficiency and how well it does in controlling its costs. Equally, total asset turnover is a measure of firm's asset use efficiency, so how well it does in terms of managing its asset. And also, equity multiplier is a measure of firm's financial leverage. So using financial statement information, therefore, is for internal use. So management use it, for performance evaluation, which means, their performance is based on, it's what they use to pay them compensation. So compensation and also comparison between division. Equally, we use it for planning, so for planning purposes for the future, and also guide in estimating future cash flows. For the external, the creditors also use it, to be able to gauge the level of credibility and if they can raise more cash or give them more advance in terms of loans. Suppliers also use it if you want to grant them credit for supplies, and customers also use it to see, how long they are likely to be in operational existence for. Equally, stockholders, they use it to ascertain if the company is worth investing in. In terms of benchmarking, This ratio also not very helpful by themselves, but they need to be compared with something, so which we call the industry average. So industry average will now tell us the general performance of the company. And as such, we look at the time trend analysis, which use how companies' performance is changing through time. And also, this is also equally useful for internal and external use as well. We also look at the peer group analysis, which compare to similar companies or within the industry, or the National Association of Industry Codes, Financial Post Data Group, and also Dun & Bradstreet. These are all credit reference agencies. Here are some problems with this method. It's not underlying theory, so there is no way to know if ratio is most relevant, but we need to just identify what is relevant and then use it appropriately. Benchmarking is equally difficult for diversified firms, and also globalization and internationalization competition makes comparison more difficult because of differences in accounting regulation in different jurisdictions. Equally, varying accounting procedure such as FIFO. FIFO means first in, first out versus last in, first out method of valuing inventory. So this is another accounting procedure which makes a comparison, particularly with the ratio, much more difficult. Also, we have different fiscal years because company can typically choose any particular accounting periods, so that would not enhance comparability. If other companies have different accounting periods, different from what we have, and so that would not enhance the ability to compare apples with apples. Extraordinary items. These are some events which can be, we can change. They are one-off situation, such as, it's a one-off big event which affect, financial performance and also reporting in the financial statements. So here's the quiz to, in terms of what we cover. We look at what is financial statement, statement of cash flows, and how we determine sources and also use of cash, and also how do we summarize statement of financial position and also comprehensive income, and why do we standardize? So these are some of the questions, and also what are some of the major categories of ratios, and how do we compute specific ratios in each of the category? And finally, what are some of the problems associated with these financial problems, which you just looked at? So in summary, what we covered in this chapter was to identify the sources and use of cash, understand the statement of cash flows, understand how to make standardized financial statements, and also why they are useful, and calculate and also evaluate common ratios, understand the dew point identity, and also describe how to establish benchmark for comparison purposes, and also understand some of the problems that arise. So that's chapter 3 in a nutshell. In chapter 4, we'll be looking at long-term financial planning and corporate growth. Thank you so much for watching.